Strong day in the market today, and that runs in pretty stark contrast to the catastrophe fears many had yesterday. But for those of you who had been following me on Twitter, Snapchat, LinkedIn, etc., saw my stories, I timed the bottom pretty well. I realized max fear, uncalled for fear, and not necessarily a fundamental reason for that. Although there is one, which we'll touch on maybe towards the end of the video. But I want to talk about why I felt so good about buying relatively volatile growth stocks in the midst of the abyss when they were down some 15-20%. Now, we've had a very long bull run, and a lot of people are very quick, and relatively rightfully so, to say that valuations are very high. And, if there's a big sell-off, there's a lot of fear that people feel that, wow, I got to take my bag and run because, the market's stretched and it's going to spill off 20-30%. That rarely happens. Rarely happens is there a massive sell-off like that. And it requires an incredible, catalyst, right? The last one, the presence of a coronavirus. A massive global pandemic. Fears about an unknown virus led the market to sell off very aggressively. But the market had recovered very quickly from that. So maybe that was a little bit of an overshoot. Now, the one before that was the financial crisis. The financial crisis was a systemic problem in the market with loans and all of these kinds of things. That happened and the market sold off. There's nothing like that here. What this scenario and fears of yesterday are more comparable to are the 2000-2001 internet bubble crash. And there are certainly some similarities between that crash. But if you've been watching these videos, you will be avoiding those landmines and you will not make those mistakes. For example, towards the end of the internet bubble, based on the homework I've done with regards to this event in history, there were many pet store online companies, things like Petopia.com, Petfood.com, Pets.com, etc., promising, some percentage of this large total addressable market and lots of future cash flows, pulling it all forward. And that's a problem. A lot of businesses recently have been being priced at valuations that are pulling forward all the gains. And if you go back, deep into the videos, you will hear this pulling forward of gains theme mentioned throughout. And it started with stocks like Zoom and Docusign, both of which I never owned. I think they are fantastic businesses, but the stock price isn't good. So we want to avoid stocks that have aggressively pulled forward all of their gains. That's what happened in the internet bubble. Everyone was saying, internet, it's a huge thing. It's going to revolutionize the world. And they were right about that. They were not wrong. It has. A lot of these businesses have, like Amazon, have tremendously surpassed those valuations. Maybe you should have held Amazon through in hindsight. But the idea is, and how to avoid some sort of valuation-related sell-off, is to buy things that aren't pulling forward too much of the gains. It could be the best business in the world. If it's pulling forward the next 30 years of gains, it's going to cause a problem because it's not sustainable. You're not going to get people willing to accept that. Some people are going to want to sell, get cash. Those needs come down the line. It's just life. And it's not sustainable for that reason. So why are we seeing tech slow down? Yes, you've talked about valuation, but there's actually a reason for it. And it has to do with rising interest rates. People, they don't just buy an investment blindly, right? They compare their options. And as interest rates tick up, the ability to take advantage of higher interest rates increases. So the value of $1 put into a bond increases. As the value of $1 put into a bond that is now paying a higher interest rate increases, the desire to put that dollar into a stock which is pulled forward the next 30 years of gains or so, becomes less desirable. So now as we're seeing the economy reopen, expectations improve, things settle down, the safety of a bond is, less ideal. Bonds are like, more about having a safe investment. So people are, chilling out a little bit. As they chill out, they're starting to sell their bonds, look to stocks, maybe not a tech stock, maybe like an energy stock with a dividend. And that's causing interest rates to go up. Then new inflow dollars are saying, okay, do I go to this risky investment that is super high priced already? Or do I go to this bond that's going to pay me a higher interest rate than it was the other day? And as the interest rate ticks up, more people are more inclined to go towards the bond. I expect this trend to continue. Do I expect it to tank the market? No. Interest rates were higher than they are now at pre-corona levels. I do think it will have some effect, but I think, broader inflation is going to happen. We have pumped a ton of cash into the market and into the broader economy. Now, the Republicans are posing very good arguments for why we should not have an additional stimulus, particularly this stimulus package. I'm not going to get into the political debate of that, but we might have some slight tapering of that inflation picture. Powell talked about some of that. So we'll have to see what happens with that. Right now, I would say we're at fair value in the market. I'm not expecting a huge move up, not expecting a huge move down. Any huge move down is a buying opportunity, in my opinion, as we saw yesterday with the NASDAQ down 4%. You could have made a nice fat trade if you somehow decided to go that route, which I didn't. I went individual names, but if you went that route, you would have made a lot of money. I made a lot of money in some things, didn't buy options, whatever. Anyways, the move is to find individual stocks that are well priced. That way, you don't need to worry about the market going up, down, or sideways. I think it's more likely to go sideways now without more stimulus. You can just hold on to the stock you have and expect it to go up because it is well priced. And there might be some inflows from somewhere coming into that well priced stock out of the expensive stuff. So focus on the price. That's number one. And in my opinion, stay long, don't panic. And if the market does get a little hot, put some hedges to protect yourself. And if the market cools off too much, start nibbling on the way down. So I hope that makes sense to you. If it doesn't, feel free to comment below. And until next time, peace out.